Welcome back to The Explainer. Today we're putting on our professional equity analyst hats to conduct a rigorous stock valuation of Matson, ticker symbol MATX. We're going to run some absolute, relative, and asset-based models to uncover a pretty glaring discrepancy in the data, all to figure out the company's true intrinsic value.
Let's just establish our baseline right out of the gate. Matson's last market close price sits at $173.55. Now that's what the market currently believes a single share is worth. But hey, as any rigorous analyst knows, price is what you pay, but value is what you actually get. So let's dive straight into our absolute valuation models to find out what's really happening under the hood.
And right away, things get absolutely fascinating. When we build out our discounted cash flow models, discounting projected cash flows back to present value using our estimated weighted average cost of capital, the data shows a free cash flow fair value of just $111.95. But, and it's a big but, if we project out earnings per share using a residual income model instead, that fair value skyrockets to a massive $249.39.
This violently illustrates the tension in our models right now. Depending on whether you prioritize cold, hard cash or accounting earnings, Matson either has a deeply negative 55% margin of safety or it's a total hidden gem undervalued by 30%. Because these absolute outputs are so fragile and honestly totally contradictory, we absolutely have to cross-reference them with other valuation methods.
Section 1. Breaking down the multiples. To solve this mystery, we're turning to relative valuation models. When we compare Matson to its publicly traded logistics peers, standard multiples actually look remarkably modest. Totally reasonable, really. We've got a trailing price-to-earnings ratio of just 12.48. The price-to-book ratio is 1.91, which is a great proxy for our net asset value baseline, by the way, and the enterprise value to EBITDA sits at just 8.59.
What's really interesting here is that the broader market isn't assigning some massive speculative premium to Matson's core operating profitability. When you adjust the balance sheet, they actually have a beautifully clean, low debt-to-equity ratio of just 0.13. That keeps the enterprise value completely grounded. It seems the market is perfectly content valuing Matson's operational cash earnings at a surprisingly conservative multiple.
However, the plot thickens considerably when we switch gears and look at the price-to-free cash flow ratio. It currently sits at a really lofty 35.34. Just to put that into perspective for a second, that multiple is up nearly 108% from Matson's 5-year average. The market is suddenly demanding a huge premium for every single dollar of actual free cash flow. For us analysts, that immediately signals that cash generation might be under severe pressure.
Section 2. Cash flow versus earnings.
That soaring multiple points us directly to the heart of this entire mystery. There is a growing chasm between reported accounting earnings and the actual cash being generated. Over the trailing 12 months, Matson brought in over $3.3 billion in revenue. That trickled down nicely to a very healthy $444.8 million in net income. But the free cash flow, the actual cash left over after capital expenditures, was only a fraction of that at just $153.7 million.
When we expand our view and look at the 3-year compound annual growth rates, the story gets even stranger. Earnings per share actually surged by nearly 30% annualized over the last 3 years. But over that exact same period, free cash flow cratered by over 47%, and top-line revenues shrank by about 8%. You literally have accounting profits rocketing upwards, while the actual cash generated and the sales coming in the door are sliding backward.
Section 3. Historical returns and growth. Now, as an analyst, you have to ask yourself how this completely unique financial profile actually affects the shareholders over time. Well, the answer is that long-term holders have been massively rewarded. We're talking about a staggering 1,177% total return over the last 20 years. That translates to an incredible 13.5% annual return over 2 decades. Not too shabby, right?
But let's be very clear here. The recent journey has been an absolute roller coaster. Just look at the extreme volatility over the last few years. You've got wild swings from a near 30% drop in 2022 directly into a massive 78% spike in 2023. Then it dips again in 2025, and now it's pacing for a 40% gain. This is absolutely not a smooth, predictable ride.
Section 4. The dividend safety net. Despite all this intense volatility, Matson actually has a surprising stabilization mechanism that makes it a really prime candidate for a dividend discount model.
They boast an impressive streak of 14 consecutive yearly dividend increases. Now, while the 0.83% yield might seem a bit small on the surface, this multi-stage streak proves management's deep commitment to returning capital to shareholders, completely regardless of those turbulent shipping cycles.
So how exactly do they maintain this streak when their free cash flow is dropping so hard? Well, they do it by keeping an incredibly conservative overall payout ratio of just under 10% of earnings. That basically keeps the dividend bulletproof. And even though their free cash flow is currently depressed, the FCF payout ratio is still very manageable at just 28%. So even with cash generation down, the dividend is entirely safe.
Section 5. Final verdict on Matson.
All right, let's synthesize our valuation models to establish a final intrinsic value range. We've got a fascinating company here with a rock-solid balance sheet and dividend, but shrinking cash flow. Our absolute models give us a massive, kind of unreliable range between $111 and $249 per share. However, our relative and asset-based proxies suggest the current $173 market price is actually a pretty fair midpoint. It perfectly balances those low PE multiples against the skyrocketing cash flow multiples.
Ultimately, Matson's intrinsic value isn't a single objective truth. It's more like a mirror. It reflects the exact valuation methodology you, as the analyst, choose to prioritize. If you build your models around the stability of net income and low PE multiples, the stock looks undervalued. But if you build your model strictly on the recent reality of cash generation, it looks significantly overvalued.
Which leaves us with one final critical question for you to take away from this explainer today. When you're looking at a stock and the fundamental numbers conflict this wildly, do you trust the cash or do you trust the earnings? Definitely something to think about as you build your own valuation models. Thank you so much for joining me, and keep exploring the data.